how much should you invest in stocks and how much in bonds? If you invested 50% in stocks and 50% in bonds, how much money would you lose in a down market? And what's the financial sustainability index? We'll answer these questions and more on this, the 49th episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to podcast number 49. It's hard to believe we've hit 49 podcasts in just a couple of months, but it's been well received. I've enjoyed getting email from a lot of folks who have enjoyed the podcast. I hope it's helped you out a lot as well. Hey, if you haven't already, sign up for the DoughRoller newsletter. It's free. I send it out every Saturday with links to articles that I publish on DoughRoller, as well as articles that I write for the likes of Forbes and U.S. News and Huffington Post. It's easy to do. It's free. Just go to doughroller.net/newsletter. Simple as that. Take you to the sign-up page. Take you all of about 7.5 seconds. Okay, let's get right to the money tool of the day. And I guess maybe I should back up. As you probably gathered from the questions at the start of the show, it's all about stocks versus bonds. How much should you invest in each? What portion of your portfolio should go into stock, mutual funds, or ETFs? And how much should go in bond funds or ETFs? I'm covering this question today in a little more detail because I've received a number of email from folks about this, and because of all of the asset allocation decisions you'll make. This isn't the only one, but this is by far, in my view, the most important. So my goal today is to give you some tools, some tips, some resources so that you can make the best decision for you and your family. Before we get to that, though, the money tool of the day. And this one relates to personal capital. If you listen to the 31-Day Money Challenge, you know that they were a sponsor of the 31-Day Money Challenge, for which I'm very grateful. And I was happy to have them sponsor that show because I've used personal capital for quite some time and like the tool a lot. But today's tool of the day is not just personal capital. It's a new feature that they've added, and it's called the Financial Sustainability Index, FSI for short. I think that's just a term they came up with to describe this tool. And to explain it to you, let me just step back for a moment and explain what personal capital is. So personal capital is a free online tool. You can connect all of your investment accounts, whether they're in your 401ks, your IRAs, it doesn't matter if they're Roth or not, and it doesn't matter, they can even include taxable accounts, brokerage accounts. So it could cover, if you invest in individual stocks or bonds as well, and options, really everything. And it's very easy to connect all of your accounts. Of course, you've got to give your username and password. I've had some folks email me and say, how do you do that? Do you feel comfortable with it? They have the same security as banks do. We know just from the news that I guess none of this is perfectly safe. You hear about the breaches at Target, and you get concerned. But I can tell you that their security is as strong as banks, from what I understand, and I've personally not had issues. And so you connect all of these accounts. And what I like about it is now it's very easy to see how the market is performing. I'm looking at my account right now, and I can see, my Apple stock is up 1.14% today. Not sure why. I'll have to look at that later. But that's up, and I have some investments in AT&T. That's up almost 1%. But Tesla Motors, that's down 4.75%. Anyway, I can see my performance over a day, a week, a month. It also shows you your, for example, your costs, what your investments are costing you in terms of expense ratios, like your 401k, which is very important. It not only shows you that, but how that will affect your returns over time, which I think is very helpful. So what's the Financial Sustainability Index? Well, the idea behind this is, with all of your accounts connected now, they can crunch the numbers. They can look at based on what you have invested, and of course your age, and some assumptions about how long you'll live. And what they do is they calculate how much money you could spend starting right now on a monthly basis, and have that money come to you every month until, say, 90, regardless of market performance. So it's a fairly conservative assessment of how much your investments can generate in monthly income. And I'm looking at mine, and it shows variability. Of course, it goes up and down as the market goes up and down. It doesn't go up and down significantly, but just looking at the last 30 days, it's gone up a few $100s since then per month. And of course, this is just an estimate. But the thing I like about it is it takes your total portfolio and it brings it down into a number that we can all understand. We can look at a number and say, okay, that is a rough idea of how much income my investments could generate on a monthly basis. That's much easier for us to analyze and to understand and to think about in terms of our monthly spending and what we're going to need in retirement. Now, of course, this isn't going to count in your Social Security. It's not going to count in any pensions that you may have, or if you've purchased some annuities. In fact, it's what it's going to factor are those accounts that you've connected to personal capital. But I think it's a great way to look at and to think about the money you've saved for retirement. Now, in my case, my wife's case, we're still a number of years away from retirement, but it still gives us a sense as to where we stand now, and of course, we'll be able to track it over time. So that's a new tool, the Financial Sustainability Index. I think it's available to everyone that signs up for Personal Capital, which is free. Again, you've got to connect your accounts to make it work because Personal Capital needs that data to calculate the FSI. But it's a nice addition to the tool sets that they already have, and you might want to check it out. I think you'll find it to be enlightening. Hopefully you'll like the result, but hey, if you don't, then you can refocus your efforts on retirement savings to improve the number. So if you want to check out the Financial Sustainability Index, obviously if you already have an account at Personal Capital, you can do that. You'll see it in there. And if not, you can check out Personal Capital. Just go to DoughRoller.net/PC, and that will redirect you to a page on Personal Capital's website where you can sign up, connect your accounts, and check it out. Okay, stocks versus bonds. I've talked about asset allocation in the 31-day money challenge. So if you listened to that, you've already heard sort of a high-level overview of asset allocation. And if you haven't, you can check out podcast 25. That's DoughRoller.net/podcast 25. That'll redirect you to that podcast on asset allocation. Today, I want to focus specifically on stocks versus bonds. By far, the most important question you have to answer in asset allocation, far more important in my view than U.S. stocks versus foreign stocks, or whether you have emerging markets or REITs, or you focus in on some small caps. Stocks versus bonds really drives the overall return of a portfolio long term. It's a very important issue. And so I want to cover it in more detail today and kind of want to go over, I guess, four broad topics. So let's kind of work through it. The goal here is to arm you with sort of the knowledge and the tools and the resources so that you can make an informed decision for yourself and your family as for what's best. As you know, there's not one right answer. That actually gets me to point number one. This is not an exact science. It's not as if you can dump a bunch of information in some calculator about yourself and out comes the perfect asset allocation, the perfect division between stocks and bonds in a portfolio. That just doesn't exist. That being said, I do think there are some wrong answers. There are some answers at the extreme where you have perhaps too much in stocks or not enough in stocks. And but even there, again, I think the key is for you to understand the pros and cons of any division between stocks and bonds, and we're going to cover that today. But in talking to folks and getting emails, I almost get the sense that people are nervous. What if I get this wrong? What if I put in 75% stocks and I should have put 70% or 80%? It doesn't really work that way. I mean, there's if you're thinking about 80% stocks versus 20% stocks, yeah, that's a big swing, and your portfolio will look and perform very differently. But when folks start to get hung up on a couple of percent here or there, 70 versus 75 or whatever, you're probably trying to put too fine a point on it. I mean, it's an important decision, but in that small frame of reference, my advice is don't get hung up on that. The bigger questions are more like, are you going to be 75% stocks or 50% stocks? And yes, we'll talk about increments of smaller increments than that. But again, this is not an exact science. That's point number one. Point two actually has, I guess, three subparts, and I want to spend a little time on this. And when you're deciding between stocks and bonds, you are really, in my view, balancing three competing issues. The first one, and the one that I think gets the most attention and that everyone is afraid of, is simple: risk of loss. We're scared of, or can be scared of, the stock market. We can see it go down, 10, 20, 30%, 40% in a year, and it gets a lot of attention. And so, we most of us, I think, appreciate that in the long run, stocks will do better than bonds, but we're scared of them. We're scared of that risk of loss. And that is one of the three issues that we're constantly balancing when we make this decision between how much we're going to invest in stocks versus bonds. And I want to suggest you take a look at a resource. I'm going to include this chart in the show notes, as well as a link to the source where I found it. And it's the Vanguard. It comes out of the Vanguard's Framework for Constructing Diversified Portfolios, which is basically a fancy way of saying asset allocation. Asset allocation is a fancy way of saying don't keep all your eggs in one basket. And in this PDF, they have a chart that it's just in one chart, it gives you everything you need to know about the potential risks and rewards of stocks versus bonds. It does it based on history. It looks at 87 years worth of stock and bond market history. And yes, just because this is what the stock and bond market did in the past, it doesn't mean it's going to repeat in the future. However, it's the best information that we have. And I think when we look at that long term, that long period of performance, at least it gives us at least the best information we have as to what you might expect over long periods of time investing in the stock market and in the bond market. And again, this will be in the show notes, but just to give you an idea, if you had 100% in bonds, you had no stocks at all, you were 100% bonds, according to this chart from Vanguard, over the 87-year period they looked at, you would average what's called a nominal return, which means without factoring in inflation, 5.5%. If you factored in inflation, of course, inflation eats away at our returns, right? They call that the real return after inflation. You'd actually only earn 2.5% over this period. Compare that to a 100% stock portfolio. You'd have a nominal return of 10%, and factoring in inflation, your real return 6.8%. So a big difference. Now, that's the good news, right? That's the return that we're wanting. That's why we like stocks. The scary news is you can lose a lot more in stocks. And so over that same period, if you were in 100% stocks, you would actually lose, in your worst year, 43%. So that would be a tough year. In bonds, your worst year would only be a loss of 8.1%. Big difference. And that's reflected in this chart. The other thing I like about this chart is it doesn't stop there. It also looks at your nominal and real returns and your best year and your worst year for a combination of a portfolio. So in other words, they don't just say 100% bonds or 100% stocks and give you that data. They also give you data on 10% increments. So 90% bonds, 10% stocks, 80% bonds, 20% stocks, and all the way up to 10% bonds, 90% stocks. And as you would expect, by and large, as you add more and more stocks, your best years get better, your worst years get worse, and your nominal and real returns slowly move up. And the thing about this is, when you're thinking about how much you want in stocks versus bonds, I think it's good to look at this and say, okay, one, will I be able to handle the kind of loss that's suggested here? Not that the loss couldn't be worse in the future, but again, this is the best information we have. So I'm looking at the chart now. If you were going to do 80% stocks and 20% bonds, this would suggest you need to be prepared for a 35% loss of your portfolio in one year. Would you be able to stomach that? Would you be able to stick to your asset allocation plan if you had that kind of year, right? So that's the first issue we have to balance, this potential risk of loss in any given year. Again, over the long term, you're going to make money. But in the short term, you could lose money, and depending on your asset allocation, you could lose a lot. That's issue one. Issue two, I call the risk of not enough. Yes, there's the risk of loss, but there's also the risk that we could get to retirement and not have enough to retire on. That's the risk if you have too much in bonds. You may feel safer having 100% of your money in bonds, but your your real return, your after inflation return, at least if history is any indication, is only going to be 2.5%, which, depending on how much you're saving, growing your portfolio at 2.5% may not give you enough at the time when you come time to retire to actually retire. And that's a risk that's sometimes hard to focus on, particularly when you're 20, 30, 40. It's so far away. You're more concerned about losing 30 or 40% of your portfolio. Who has time to think about whether you'll have enough 10, 20, 30, 40 years from now? But it is a real risk. And it's why I think so many experts recommend a portfolio for retirement that is weighted, sometimes heavily weighted, in favor of stocks. Because if you can overcome the urge to sell your stocks when the market is down, if you can deal with that sort of short-term volatility risk, then you can have a portfolio that's weighted heavier in stocks and address the real risk of not having enough. And again, that's a hard risk to feel. We can feel the stock market risk because we can just look at the market and when it's going down. That's an easy one. We all feel that when there's a bad day, bad week, bad month, bad year in the market. But the risk of not enough, that's a lot harder to conceptualize when you're decades away. But it is such a critical risk, and it's why this question of stocks versus bonds is so important. The third issue you have to balance, and I've already touched on it, and it's a big risk, and it's you. Sometimes we are our own worst nightmare when it comes to investing. You've heard the stories where the stock market, starts to crash, and people were invested in stocks. They get nervous and they sell. They sell when the market's down. And then, it bottoms out and starts to improve, but they're still scared. They want to wait. And then what do? They buy into the stocks when the market's on fire, just in time for the stock market to crash again. And I've talked to a number of people who did just this in 2008. The market was down, and out of fear they sold, and they're just kicking themselves now. So really, the question between stocks versus bonds has to address these three issues. You've got to have an understanding of the kinds of loss your portfolio may incur in a given year. You need to consider, all right, I got that risk, and that's a real concern. At the same time, I've got to be focused on the risk of not enough. I can't just focus on that short-term risk of market loss. I've got to think about, all right, if I want to go more towards bonds, fine, but is it going to generate the returns, the real returns I need to meet my financial goals, primarily for most people, retiring? And as you think about those two issues, then you need to think about yourself and how you're going to handle a market loss. Those are sort of the three sort of competing issues, if you will, that I think go into this question of stocks versus bonds. And I highly recommend that you check out this chart from Vanguard. I will include it in the show notes to this podcast, as well as a link to this PDF. It's a really good kind of white paper, if you will, that Vanguard put together on portfolio construction. But the chart is just, a picture is 1,000 words. This, in one chart, you'll get a real sense of how different portfolios will behave, and I highly recommend that you check it out. So those are sort of the three issues we have to balance. Now, all right, that's fine. We know that it's not an exact science. We know we've got to deal with these three issues: risk of loss, risk of not enough, and our own risks as we make mistakes. That's fine. Okay. So, but where does the rubber meet the road? What should our asset allocation be, or can we sort of narrow it down to some options and so forth? And so here's my view. If you've got 20 years or more to retirement, I think most folks that I've read, and I've read a lot, and I've talked to a lot of folks, suggest the stock should make up somewhere between 60 to 90% of your portfolio. Now, that's a big range. When I look at the Vanguard chart, the difference between 60 and 90% in terms of real returns is significant. And just looking at the chart, you're looking at a difference between about, say 5.5% real return with a portfolio of 60% stocks, 40% bonds, all the way up to about 6.5% if you've got 90% stocks, 10% bonds. And you may be saying, well, all right, that's just 1%. Is that a big deal? Well, it is. And you recall one of the issues we're balancing here is the risk of not enough. And so, is 1% a big deal? Well, it is, and I'm going to show you that. I love Excel formulas. This is an easy one. Here's what I'm going to do. In Excel, in the function box, equal sign, followed by FV for future value, and open paren, and we're going to put our return. By the way, what I'm calculating is the future value of a portfolio with a couple of assumptions. So what are the assumptions? Well, the first is that the portfolio earns 6.5%. That's what was in the Vanguard chart if you had 90% stocks and 10% bonds. And again, this is a real return, meaning after inflation. So that would be 0.065 in the Excel formula. I'm going to put a comma. I'm going to assume you invest for 40 years. Start when you're 25, retire when you're 65. Another comma. How much you're going to invest? Again, you can put anything in here for your own self, as you're doing this, but I'm going to put $15,000 a year. I'm going to make it a negative number because that returns a positive number in the Excel formula. So what do you think? I'll give you a second to kind of think. What would the value of your portfolio be? You invest $15,000 a year for 40 years at a real return of 6.5%. $2.6 million. That's what you end up with. Now, that's a real return of 6.5%. What if you invest in 60% stocks and 40% bonds so that your real return now is 1% less? Now it's just 5.5%. What does that do? What's that do to your $2.6 million portfolio? Well, again, just change the 0.065 to 0.055, and 2.6 million drops to 2 million. Big difference. It's $600,000. That is a big, big difference. So these decisions have real impact. And that's one of the reasons, by the way, that I stress so much keeping your investing costs low. If you're paying an investment advisor 1% a year, that's huge. Or if you're paying expense ratios of 1.5%, as opposed to maybe 10, 15, 20 basis points with a Vanguard fund, it can have a huge, huge impact on your portfolio. And I discussed this at length in podcast 28, DoughRoller.net/podcast 28. I talk about investing costs in that podcast. So, going back to the returns and the difference between, say, 6.5% real return and 5.5%, as you compare, say, a portfolio with 60% stocks versus 90% stocks, you may be scratching your head and saying, well, wait a minute, Rob. All right, I get that. I get how 1% can make a big difference. $2.6 million versus $2 million. Got that. I got the importance of cost. But here we're talking about stocks versus bonds. Why wouldn't I just put in 90% stocks? I mean, 2.6 million is better than 2 million. I got that figured out. So why wouldn't that be the answer for everybody? Well, there are a couple of reasons. One is we go back to this whole risk tolerance. Yeah, 90% stocks should return a higher return over a long period of time than 60% stocks. But to achieve that, you are going to have to live through a loss of 30, 40% of your portfolio in a given year. Can you do that? If the answer is no, in my view, you're better off at 60%. You're better off at 60% stocks than trying to stretch to 90% and selling your stock funds when the market goes down out of fear. If that's what you're going to do at 90% stocks, you're better off with a more conservative portfolio. And of course, only you can answer that. And I'll tell you that one of the things for me that I found helpful is, this comes with some experience, but I've lived through a number of bad markets, right? I was investing in 2008 when the market crashed. I was investing in 2000 during the tech bubble and burst. So I now have some experience living through these bad markets, and I know that I will stick to my asset allocation plan. I know that. But if you're just starting out, you may not know that yet. It's one thing to sit, and listen to this podcast or read a book or read a website or blog or whatever. And that asset allocation sounds great. It's a whole nother thing to live it. And so, this will come with some experience. If you've lived through a bad market, you know how you'll react. But you also have to consider if you're married, if significant others in your life, how they're going to react. It's not just you. It's your family and how they're going to react to this and what influences that's going to have on your investing decisions. So that's why there's not one size fits all. It's not enough to just look at a portfolio and say, oh, well, I like the returns of this one, so I'll go take it. And you gotta ask yourself, how are you going to handle the bad years. But again, when you've got 20 plus years for retirement, I generally think you need to be in stocks 60 to 90%. If you're at 100%, one could make the argument that that's get you the best return, and that's where you should be if you've got a long time to retirement. Again, my big question for you would be, how will you handle 50% loss in your portfolio? Because I think that's a very real possibility over a long period of time. Certainly 45%. How are you going to handle that? If you're below 60%, if you're particularly significantly below, you've got 25% stocks, then my question to you is going to be, all right, you're not going to have the volatility, but are you going to earn enough? And are you willing to save even more money so that you can reach your retirement goals, given the likelihood that your overall return will be significantly less than if you had more stocks? Now, for this, again, retirement investing, in this sort of point 3 that I'm talking about, where you've got 20 years or more to retirement, there are a couple of other resources that I want to share with you. I've talked about some of these in the past, but I got 5 resources that I want to address very quickly. That you can use. One is target date retirement funds. I've talked about these. Vanguard has them where you invest in one fund. They divide up your investments into a couple of different funds, and then as you get closer and closer to retirement, they make your investments a little more conservative by investing more in bonds. The thing about these target date retirement funds, though, is I think they can be a great way to research at least how Vanguard views asset allocation. Doesn't mean you have to invest in the target date fund, but just looking at their asset allocation and their division between stocks and bonds can give you some insight into how Vanguard sees this. And I actually talked about these funds a bit in the podcast on asset allocation when you have little money. That was podcast 45. So you can check that out if you want. But I think it's worth going to the Vanguard website and just seeing how they allocate investments between stocks and bonds in their target date retirement funds. And of course, I'll leave a link to that in the show notes. That's the first resource. The second one is Warren Buffett. He talked about his asset allocation, the advice he's going to give the trustee who will manage money he plans to leave to his wife in his will. And he was actually at 90% stocks, 10% bonds. That was his view. It doesn't mean it's right for you, but I certainly think when it comes to investing, Warren Buffett is a very good person to listen to. I talk in detail about that asset allocation and his advice to the trustee in podcast 41. Again, DoughRoller.net/podcast 41. A third source is Rick Ferri. I think he is an excellent resource. He's written some great books. One of my favorites is all about asset allocation. If you don't know Rick, he manages over $1 billion in assets. He's a big believer in low-cost index funds from the folks at Vanguard and others. I interviewed Rick. I've known Rick for a number of years. I interviewed him in podcast 3, so you can check that out. In his book, All About Asset Allocation, he does suggest a couple of different portfolios depending on your risk tolerance. And I think roughly they fall in the range of 60% stocks, 40% bonds, up to maybe 80% stocks, 20% bonds. Although in that interview, if you listen to it in podcast 3, he does talk about his children's investments. They're in their 20s, I believe, and they're actually 100% stocks. I want to say a few things about that in just a minute. But that interview, I think, is a good source of information for you, as well as his book, All About Asset Allocation. The fourth resource is the Bogleheads. They're named after the founder of Vanguard, and they have some model portfolios. They call them the lazy portfolios. They have a 2-fund portfolio, a 3-fund portfolio, and some that are more complicated. I will link to these lazy portfolios in the show notes. But the thing I like about this resource is it not only gives you some ideas as to the allocation between stocks and bonds, as well as some other asset classes, but it also suggests the specific Vanguard funds you could use to implement these asset allocation plans. So it'll give you a little bit of of all of this, not only the planning, but the execution. But again, for our purposes, it'll give you some, I think, really good ideas of how much to put in stocks versus how much to put in bonds. So that's a great resource. The fifth resource is one that I just found recently, and that's the Morningstar Lifetime Allocation Index. A bit of a mouthful. I will leave a link in the show notes. What this does is it's a single page, and what Morningstar does is they break down 3 different investing styles: aggressive, moderate, and conservative. And for each of these 3, they suggest allocations between stocks and bonds depending on how long you have to retire. And the longest they have is 2055. So if I can do the math here quickly, I guess that would be 40 years from now, 41 years from now. And it goes all the way actually to retirement in 2000. So those that would be for folks that I guess retired 14 years ago. And they show you their recommended allocation between stocks and bonds. I can tell you for those retiring 40 years from now, the aggressive portfolio has 92% in stocks, the moderate portfolio 88%. And listen to this, the conservative portfolio 79.92%. That's the conservative portfolio is 80% in stocks. Again, for folks that plan to retire 40 years from now. So you can see that Morningstar is a big believer in a pretty heavy weight in stocks, again, for those folks that have a long time to retire. And then you can see how their portfolios change as you get closer and closer to retire. It's a great resource. It's a single page, very easy to understand. I will leave a link to that in the show notes. As you know, if you've listened to my podcast for any length of time, though, I'm a big believer in using this information, learn from it, use it to help make a decision that's right for you, but don't follow it blindly. Okay, point 4. I alluded to this a little bit earlier, but it's this whole business of 100% stocks. I get a number of emails and comments to the blog about folks who say, if you've got 20, 30, 40 years to retirement, you should be 100% in stocks. Theoretically, I can't argue with that view. And there was a time when we were pretty much 100% in stocks. This was a number of years ago. Here's the problem, and again, I alluded to it earlier, is can you stay at 100% in stocks, or will you be tempted to sell when the market is down? And here's the thing to keep in mind. When the market is down, a lot of other bad things are happening. So take 2008, for example. It wasn't just that the market was down big time. What else was going on? Well, the housing market was a complete mess. People were underwater, and they were scared. Unemployment was going up, and we still haven't recovered from the impact that 2008 had on employment, but people were losing their jobs, and they weren't just losing their jobs. They were finding it difficult to find new jobs, even 6 months or a year later. There was a concern that our financial system was going to collapse, right? It's so easy to forget these things. It wasn't just about a bad market. When the markets are down 30, 40%, there are a lot of other ugly things going on, and they're scary. I mean, let's be honest. I mean, they're scary. And so when you think about whether you can stick to 100% stock allocation, it's not just about the market. It's about all of those other things going on. Now, if that's the choice you've made and you think you can stick to it, great. That's your decision. I think it can be justified, theoretically. But my view is that out of 100 people that are invested 100% in stocks, probably 98 of them shouldn't be. I think it's a rare breed of folks who can truly stick to a 100% stock portfolio during an ugly market like we had in 2008 and into 2009, or if you want to go back further, when the tech bubble burst. A lot of bad things are happening besides the stock market when that happens, and you got to be able to stick to your guns. So that's my view on 100% stocks. I think very, very few people are really built for that kind of asset allocation. That's my view. Okay. The fifth and final point, as you think about stocks versus bonds and what's right for you, is this. I think it's important not to look at asset allocation in isolation from the rest of your finances. I think it's important to think about the debt you have, your savings rate. Are you saving 5% or 25%? Your spending needs. Are you able to get by on relatively low amounts of spending that allow you to save a lot, or are you spending a lot right now? Your career, how stable is your job? If you were to lose your job, how easy would it be for you to get a comparable job? Are you in a market that's vibrant and growing, or like the technology industry, or engineering, or is your career one where if you lost your job, you'd be hard pressed to find another one where you're making the same amount of money? And you may be saying, okay, but I get that. Those are all important. But what in the world do they have to do with how much you should have in stocks versus bonds? Here's the thing. I think all of those factors go into the question of whether you will be able to stick to your asset allocation plan during difficult times. If you've got a ton of debt, if you're saving but not a whole lot, if your career's on shaky grounds, I think you're much more likely to abandon your asset allocation plan if it's heavy in stocks when you hit a bad market, when the market's down, because you've got all of these other pressures hitting you. But, if you don't have much debt, if you're saving a decent amount of money, if you're in a career that if you lost your job, you could probably find another one easily, I think you'll be less likely to abandon an asset allocation plan that's heavy into stocks, the 80, 90, maybe even 100% stock allocation. So I think that's why I think you need to look at other factors outside of asset allocation and outside of stocks versus bonds. It'll help you assess what kind of stocks versus bond allocation you'll be able to stick with in good times and in bad. So anyway, that's my sort of high-level view of stocks versus bonds, where I think most people should be, some of the issues I think you need to consider as you make the decision for you, and some resources to help you do it. Again, I'll have links to all of those resources in the show notes, and as always, hit me up with an email if you have any questions about that. And so that brings us to the money tip of the day, and it's an interesting question, at least I think it is, and it's this. How long does it take to save 1 month worth of expenses? We talk about an emergency fund, and folks often say, well, you need 3 to 6 months of expenses, which may or may not be right for you. But whatever it is for you, let's just think about saving 1 month's worth of expenses. How long will that take? So the formula to figure this out is very simple, but I think in looking at it this way, it's really eye-opening. So what's the formula? Well, let's think about take-home pay, so after taxes, and divide your take-home pay into 2 buckets, how much you spend and how much you save, right? And once you have that, it's simple. You take what you spend, the percentage, and divide it by the percentage that you save. And so, for example, let's say you're able to save 5% of your take-home pay. Well, that means you spend 95%, of course. Well, 95 divided by 5 is 19 months. So that's how long it will take you, almost 2 years, I guess a year and a half, to save just 1 month's worth of expenses if you're saving 5% of your take-home pay and spending 95%. Now, of course, that doesn't include any interest you may earn on that, say in a high-yield savings account. But as we know, the rates are so low today, that's not going to help much, and in fact, is less than the rate of inflation. So you can almost ignore that. So think about that. Saving 5%, 19 months to save just 1 month's worth of expenses. Imagine if your goal was to save 6 months worth of expenses. All right, what if you doubled your savings rate to 10%? You spent 90%. Well, 90 divided by 10, easy enough. 9 months. The interesting thing here is, as you notice, is as you save more, of course, you spend less. And as you spend less, you have to save more to equal 1 month's worth of expenses. So as you increase your savings rate, you're kind of getting a double bump. You're not only saving more, but you have less to save to equal 1 month's worth of expenses. So just by going from 5 to 10%, you drop the time it will take you to save 1 month's worth of expenses from 19 months down to 9 months. And we can keep going, right? If you saved 15%, you spent 85. 85 divided by 15 is just under 6 months. And at 20%, it would take you 4 months to save 1 month's worth of expenses. And 50%. Now, you're thinking it's crazy. No one could save 50% of their income. Well, if you've been listening to all these podcasts, that you can. And if you're thinking, wait a minute, show me someone who saved 50% of the income, I'll just suggest you go to DoughRoller.net/podcast7 to hear about the guy who did that and retired at age 30. But if you were able to save 50% of your take-home pay, 50 divided by 50 is 1. Take you 1 month, of course, to save 1 month worth of expenses. Now, all of this can be a little discouraging. Maybe you're not saving anything, or maybe you're saving 5%. You think, my goodness, I got 19 months just to get to 1 month's worth of expenses. Well, I suppose that's the bad news. But the good news is if you can get that savings rate up, those months drop quickly. And it really underscores the importance of saving. It's not easy, I know that, but it shows you that if you can ratchet that savings up, the amount of emergency fund you can put away increases significantly. And of course, it will do the same for other types of savings. You may not be saving for an emergency fund anymore. Maybe you're saving just for retirement, your child's education, but bringing that savings rate up, even from 5 to 10% or from 10 to 15%, makes a huge difference. And if you can become a super saver, which for me is 20% or more, that's kind of where I put it for a super saver, you'll be able to really build wealth and achieve financial freedom much, much more quickly. Well, that brings our show to a close. As always, feel free to shoot me an email, dr@doughroller.net. Happy to hear from you. I respond to every email and include, you can certainly ask questions in those emails, but I also get readers that send in email that says, hey, can you cover a topic for me? And happy to do that. In fact, one reader emailed me recently to ask me to talk about tax loss harvesting. So that's a topic that'll be coming up in the future. But if you have a topic you want me to cover, would love to hear from you as well. All right. Until next time, remember, the best thing money can buy is financial freedom.